Good afternoon, everyone. Warm welcome to all of you who have joined with us here today in the CA Speakers Forum session. This is a session number 11 since this initiative in this new year, and we are back here again with the transfer pricing session. Now, transfer pricing, if we look at the regulations all across the world, we can say that it is very close to 100 years since regulations were introduced in any part of the world, and very close connection to transfer pricing is of related party. And if we talk about the IFRS standard being introduced, it is close to 50 years since the standard was introduced for implementation in different countries. And we, coming from chartered accountancy background, we have studied these standards, we have studied taxation from our education side. But if we look at UAE, the regulations for taxation specifically have evolved in the last one decade. And if we specifically talk about the significant changes in transfer pricing or the regulations being applicable to the organizations in a very significant way, then we can safely say that it's mostly with the implementation of a corporate tax in the last 3 years since the regulations have been introduced and evolved. And 1 year has passed when all the organizations, I would say, in this part of the world would have filed in UAE, would have filed their first tax return if they have been in existence for more than for more than a few for more than a year or 2 years time, they would have filed their first corporate tax return. So we felt that when the regulations have evolved, when one corporate tax return the organizations have filed, it's important to see and look back where we stand today, where how our compliance journey has been, and how we are facing this world, what challenges we are having. And in this scenario, over the last 1 week, since a recent public clarification has come on this related parties, there has been a lot of discussion I see in different groups with regard to that scenario, when what I see is there have been a different views on it. And this is has become a significant matter of discussion, though the public clarification is not that detailed. But the kind of discussion what is happening, I see, is very much significant. This is of interest to a lot of people, and there are different views around it. There are discussions, significant discussions around it. But we don't have to lose our focus. We have to be focused towards the things, everything that is of significance to you, everything that matters in this subject, and everything that can make a significant difference to you as you continue your journey in this taxation space, in seeing that your understanding is clear and you are compliant. And today we have someone who is an authority, I can say, on the subject. I have known Ajit for close to a decade, and it feels me uh, very great to introduce him as someone who takes significant efforts to do the research, take part in the research activities of ICAI. And when he had been awarded for his research paper in ICAI, I think more than 6 or 7 years back for the first time. That was a significant time when I had a significant interaction with Ajit. So he is a fellow chartered accountant with a significant experience. He is an author. He leads the practice in a leading accounting firm here in UAE for transfer pricing. And his interest and the way he speaks to everyone, the way he respects everyone, the way he fairly treats everyone's viewpoint is what makes him a very true professional. Thank you, Ajit. Thank you so much for taking out time and being here, accepting our invite to be here with us, and your authority, your understanding, your expertise in this subject will make a significant difference to each one of us. And before I hand over to you, I request all to please help me welcome Ajit with lot of love by showing the emojis which you can use through Zoom. And as you show your love, I invite you, Ajit, to say your first words for this afternoon.
Yeah. Thank you, sir, for your kind introduction, and thank you very much for inviting me on this esteemed forum. Now, first of all, I would take this opportunity to thank you for building such a wonderful platform. And this is directly coming up from my heart because I've been following you, and the way you have built up this platform is really making bringing a different level of change. Why? Because we are talking about here conversations. We are not talking about any event or any topic only. We have been doing conversations, and the way you have been inviting different professionals, giving a lot of opportunities to the different chartered accountants, young chartered accountants, is truly amazing. And this really gives an opportunity to bring something very real, to connect with the people, to connect with a lot of professionals. And I can truly say that after we agreed for this program, and after agreeing this program, so many people told me, yeah, I mean, you have been doing this with sir, I mean, it's a great opportunity. So it's being feeling really real on this platform.
Thank you.
We want to make it very real, and it's not only about just conducting a program. It's also about consistency, the way you have been inviting professionals in so consistent way, and they have been contributing. It's truly amazing. And definitely it's a different level of work, and it has been a real contribution to the profession, to the community, and the overall development of the profession. I truly, from the bottom of my heart, I would like to thank you. And in fact, I would like to say, request everyone to to press react on as a heart in the respect of the sir, because this has been really truly amazing work you have been doing for so many years, and bringing people together, because in such a chaotic world, bringing people together is a real challenge. It's not an
Yeah.
easy task. So I
Thank
would
you.
like to really thank you for this, and thank you once again for this opportunity.
Thank you, Ajit. This is so nice of you. It's see, important is that knowledge gets shared and gets shared in a wider way. So, though we are very few people who get impacted, less than 100 people join in the call or through YouTube, but we are able to join attendees from all over the world. That is the difference we are able to make it. So here I can see members from at least 7 countries who are present here today at this moment, and I hope many will join later. And without further ado, it is important that we get on to the subject with your experience and expertise, and the screen is all yours. Thank you.
Thank you very much, sir, and thank you
Thank
once
you.
again for this
Thank you.
opportunity.
Yeah.
Should I share my screen now?
Yes, yes, please go ahead.
So, welcome again, everyone.
Yeah.
So today's session is not we'll not go back to the basics of compliance, as Sir has already mentioned about the key areas, what we need to focus. The focus is very important, and one of the most important thing is the history. You know what Sir has mentioned, that it's been now 100 years. How the arm's length principle has evolved. In 1930, the arm's length, the terminology used once in the US, and then it is evolved by the OECD in the 70s. The OECD has introduced the OECD transfer pricing guideline, and then we have seen the world in last 2 decades. We have seen specifically, we have seen significant amount of transfer pricing litigation, specifically in India and other parts of the world. Now, before I start the session, it is important to go back to the basics and the history. See, what happened is in last 2 decades, we have seen huge amount of transfer pricing litigation and adjustments. And even those adjustments happened even when there were transfer pricing documentation in place, there were properly TP disclosure have been filed in the countries, but still the tax authority didn't agree. Why? Because the countries are very aggressive in terms of getting the fair share of tax revenue. Every country wants to get the fair share of tax revenue, and they don't want to lose any or want to see anything happening which is resulting into base erosion of tax. Now, transfer pricing is one of the important international tax issues where there can be a lot of base erosion possibilities. And because of the same, if we see, these are two era of transfer pricing: era before 2015 and after 2015. Now, before 2015, when there were no BPS, BAPS, when there were no specific local file master file, there were transfer pricing regulation in place. But then when BAPS action plan have been introduced, was introduced by the OECD, the specific point was that transfer pricing outcome should be aligned to the value creation. See, after 2015, a lot many tax authorities have been focusing on value creation, control, decision making. And if we can see a lot of landmark ruling, we can see recent Netflix ruling or Hayat ruling in India or various other places in the world. So many rulings are talking about value creation, control, decision making, substance. So the transfer pricing journey is started with the compliance, but then today we are seeing an era where more and more tax authorities are focusing on the substance. And that's the reason even our local file, master file, all the compliances are in place. We can see a different result during the transfer pricing audit because tax authority want to see a more deeper substance. Now, I'm not saying that the tax authority always goes with the real logic, because we have seen in many countries in the world tax authority at the lower level, the adjustment is not appropriate a lot of cases. But when you see the tribunal level, the level of the level of discussions, the level of orders are completely different, and they are more substance oriented. And as I said, so the point I'm making here is that the transfer pricing should not be just seen as a subject of compliance. It should be seen as a subject of economics, substance, value creation. And these things can be achieved only when we achieved when we not only focus on the compliance, the regulation, but also focus on the business part of it. In a lot of cases, we focus a lot of on compliance, that okay, we need to meet the deadline, file the local file or prepare the local file, do the function analysis. But when we go into the deeper of the value chain of the company, we find a lot of other issues. And I take a very, before I go into the slides, I take a very interesting example in, because I've had an experience of representing in almost tax authorities in almost 3 to 4 countries: India, Saudi, UAE, and India, Saudi, UK, uh, and Qatar as well, to represent before the tax authorities. Now, one thing I've realized, that specifically one of the experience in India, where tax authority one day asked that I want to meet the research and development head of the company. You're fine, you are coming with finance head, tax head, but I want to meet the research and development head, and I want to meet him tomorrow. So then the real problem happened, because the R&D head had no idea about the value chain and transfer pricing and arm's length principle. But then even he was briefed, when he met the tax officer, the level of results were different, because the research and development head of the company spoken about a lot of other things which was not even documented in the local file. So the point I'm making here is that transfer pricing is not just a tax subject. We can talk about accounts, tax, finance, and connecting all these. But when we look into the real transfer pricing, the orders of the tribunal, high court, Supreme Court, one thing which is coming out very clearly, that in order to deal with the transfer pricing, in order to address the transfer pricing challenges, it is very, very important to understand the entire value chain of the company. And this is possible when we talk to the various stakeholders of the company. It can be operation head, it can be R&D head, it can be value chain or logistic head of the company, to understand the value chain where the value is created. Now this things is coming up very why I'm bringing this very strongly, because in today's time a lot of integration happening in terms of the value chain analysis. In terms of the value chain, a lot of departments are integrated. Now today only in the CA event, I was talking to someone, and in his company he was talking that all the decisions are taken by AI. No, it was just taken at a one level, and all the subsidiary level it is taken by artificial intelligence. There were no human involvement. Now look at, in such a evolving world where AI is taking over, and we are still following the traditional arm's length principle and traditional guideline, that really won't may not work. Now it is, I'm not saying that this needs a new regulation, but the point is that it needs a new mindset of how we see the transfer pricing. We should not see only from a compliance perspective. Now with this background, I'll start with today's session. So we have 1 hour's time, but we'll focus on what we have seen in last 1 year. So 1 year of UAE transfer pricing compliance is over, and we have seen a lot of challenges. We learned so many things about the UAE market, how data is managed, how compliance has been done, and how we have addressed the challenges. And we will discuss all those things. We'll talk about arm's length principle, because in most of my session, first thing I start with arm's length principle, because that's where the focus is. What I believe, in my experience working in different countries, any problem in transfer pricing can be addressed if we focus to the basics of the transfer pricing, the fundamentals of the transfer pricing. We'll talk about certain case studies which we faced during the 1 year of transfer pricing life cycle and how we address those challenges. And finally, we also talk about, as sir was discussed about the new notification of the FTA director and officer. And finally, we talk about the way forward. Now, we have seen the first year of UAE transfer pricing compliance cycle, and it has been an interesting journey, and it has been challenging also, not only for taxpayer, tax consultant side also. It has been challenging because the regulations were new, and when any country introduces regulations, there is a possibility that certain areas there's no clarity. So we have to manage that clarity based on the more pragmatic approach, that how to take the approach. So we'll talk each of those areas one by one. Now, what I've seen over the period of 1 year, working in different industries, working with different clients in this region, there are challenges we face, but we managed to address those challenges. We managed to train the clients. In fact, at the taxpayer level also, there have been a lot of effort had been made by the taxpayer to managing the data, to understand the transfer pricing. So the first point, I've seen that in number of cases there were no TP policy or no intercompany agreement. I've seen in number of industries where the transfer pricing policy does not even exist. Any transaction, let's say purchase and sale, the payment is made on a lump sum basis. There was no policy, a consistent policy that, okay, this purchase is made, but there's no on lump sum pricing, but there's no consistent policy on arm's length basis. In many cases, intercompany agreement was not there. Now, intercompany agreement is not mandatory, but then it is very, very important to bring before trust before the tax authority. So whenever any audit happens, the first thing the transfer pricing officer asks after local file and master file is the intercompany agreement. So number of cases we recommended that there should be an intercompany agreement, which brings more transparency in terms of the overall terms and conditions, so that in case of audit, it brings more visibility. Now, one thing I want to talk about here is that in transfer pricing, there is a term called conduct versus contract. Now, contract is important. Contract is very important, but more than contract, conduct is very, very important. I'll give you a practical example. In one of the case where the company is a trader, buying and selling electronic item, just buying and selling as per the contract. The contract says that the company is just buying and selling. It just buy and it sells. It does not even maintain too much of inventory. Now, what happened is when we did the functional interview is needed for the understanding the characterization of the entity. We found that the entity is not just buying selling. While it is written in the contract, it is buying and selling. But during the functional interview, we found that the entity is also doing negotiating with the vendors. It is also doing a lot of marketing efforts. A lot of they are doing some other activities as well other than this. So all those things are not part of the contract. But when we interviewed, we found out, and then we found out that okay, we are fine. We know that in the agreement it is written at a limited risk distributor, but as per the actual conduct, it is not a limited risk distributor. It is a full-fledged distributor taking the market risk. Okay, so that's the kind of situation we faced, and that's where the conduct is very important. Actual conduct of the parties, because when the audit happens, the tax authority not only see the contract, they'll talk to a lot of people. They may call the research and development head of the company. They may call the marketing head of the company. They may go to your website, right? So a lot of things can happen. So conduct is very important. Another thing we found in the last one cycle, that loan is an important transactions in this region, because of the funding is so important for running the business, and specifically in the UAE market. What we have observed, that in a lot of cases the loans have been given interest free without charging any interest, and in number of cases there were no regions. I mean, even a loan was, see, when the loan was given between two domestic entity, to some extent one can understand that there's no base erosion, but the both entities at a 9%, still arm's length principle applicable. But then we have seen the number of cases where the loan is given to cross border entities at a 0% interest rate, interest free loan. Now that creates a problem, because tax authority, nobody in an independent scenario would give any money to anyone, any other entity without any interest. So we have seen those situations, and in number of cases we recommended to charge interest and add, or where the books are closed, it's important to do the adjustment in the tax return. So we have seen that situation of the interest-free loan. Now, when we talk about the loan, there can be different scenarios where, if the loan, in number of cases, I get a lot of queries about that. If the company has availed the loan at 0% rate, let's say a company is availing loan from its owner only, will that be at arm's length? 0% loan borrower. Now, the point here is that any loan with a 0% interest for a borrower is always deemed to be at arm's length, because in an independent scenario, as in an independent scenario, there will always be some 5%, 7% interest rate. But if the company is not paying any interest, it is good for the FTA, tax authority. There would not be any tax-based erosion. So we have seen those scenarios as well. Then another scenario, we have faced the significant outstanding receivables in the books. We have seen number of cases where they were trade receivable at the year end, and those receivables are from 2 years, 3 years, 4 years, 5 years, and there were no interest charged on that receivables. Now, when we asked, there were no reasons for the same. Now, there are two issues here, and I'll talk about those two issues in relation to the receivable. The one issue is that there is an article, if I correctly understand, Article 61 in the UAE corporate tax regulation, which talks about that if your closing balance should be your opening balance, and it should be at arm's length. Article 61 is talking about this basically transitional provision, where your closing balance before the introduction of the UAE corporate tax regulation should be your opening balance, and that opening balance needs to be at arm's length. Now the question comes that the receivable can be for last 5 years, 10 years. To what extent we can go back and charge interest on the opening balance? Now, there's no answer to it, because there's no clarity by the FT on this. Pragmatically, we take 1 year interest, that if there's an opening balance and it is outstanding for, let's say, more than 5 years, one can take a position. Let's not go back to the 5 years. There's no clarity. But pragmatic approach is, let's take 1 year and charge interest and apply interest accordingly. I'm talking about opening balance based on the transitional provision. But then there's no clarity. So as an advisor, I would always recommend to go back to the FT and get clarity, but there could be a pragmatic approach. We have seen number of cases where royalty is paid to the related party outside UAE, and that payment is just a book entry. There were no benefit documented. The royalty is being paid from last 5-10 years, and there's no benefit which is coming flowing through. So we have seen those situations. See, the important point is that when we talk about the royalty, it is very, very important to understand that it is not only about discussing the arm's length analysis of the transactions. So today, if an entity is paying the royalty at rate of 5%, I can simply do the benchmarking analysis and compute, okay, I'm paying 5%, the comparables are in the same range, it is at arm's length. But it is not. Why? Because the second leg we have completely missed, and because of the second leg, there's a significant litigation happened around the world. Now, I've seen number of litigation on account of royalty, not on the benchmarking rate, but on the basis that there's no benefit is basically documented by the entity. If I'm paying royalty, I should show some benefit. What could be the benefit? It can be my sales have increased, my product quality has increased, my profit have increased. So there can be many benefit can be presented in the documentation or local file, but in number of cases it is not there. So it is very, very important when we document the royalty transactions. The royalty can be arm's length only when we document the overall benefits which we are getting. And in one of the interesting case which I've represented before the tax authority in India, the tax authority in one of the clients, which is one of the biggest FMCG company in the world, which has a presence in India, they have been paying royalty to US entity for last 20 years. And this is a FMCG product, and they have been paying royalty for last 20 years, and they have been computing an arm's length. And one day, the tax officer asked that, why are you paying royalty? I know it is that you are computed at arm's length basis, but why you are paying royalty? Because you have so much of infrastructure, you have so much of people, you are operating as an entrepreneur in India. You could have easily, developed this technology locally. I mean, I don't see any value which you are giving to me that you need to get that technology from US. It can be easily developed here. Now, on that ground, the tax officer adjusted the royalty that I don't believe that you need to pay the royalty because you have been paying from last 20 years. 20 years is significant amount to build that technology locally. So this kind of adjustment happens, when we look into the from an audit perspective. Another area which we have seen is service without benefit test. So a lot of cases we have seen that payment is made for the accounting payroll services, but at the same time, locally there are people hired for providing the accounting services, for performing the similar work. Locally, people hired, and at the same time, company is also paying to the related party. Now that payment can be easily computed on arm's length basis by doing some benchmarking analysis and markup. But the problem happens when the tax authority sees that locally you have so many people doing accounting work. Why are again paying to your related party? And that's where substance comes into the picture. And I've seen number of cases where tax authority challenged this and disallowed the entire payment of the accounting services on account of duplication. So duplication is very, very important. And then there are other issues which we have seen is like cross entity employment, where I've seen that in specifically in the UAE, where the employees are hired in one company on a payroll, but those employees are providing services to another company. Now, what has happened is I've seen number of cases where the markup is charged by one company to another company on the cost of the employee. And this has been a significant issue because if one entity is just doing payroll work and claiming the entire markup on the overall cost of the employee, where the employee are working for another company, it is not appropriate from a sound transfer pricing principles perspective, because the company A, which is just doing payroll, is just doing administrative work. It is not supposed to get 5 or 10% markup on the entire cost of the employee. That would be really significant. So the important, we'll discuss in a separate slide. So one of the issues we faced. Then we have issued another issue we faced is the losses in transfer pricing. A lot of companies are into losses, and specifically into losses. How we address the transfer pricing, that I will discuss in a separate slides. Then there are other issues of trader versus distributor, which is very common in from a UAE standpoint perspective. Trader versus distributor. Now, UAE is a hub of trading companies. So many companies are doing trading. But then, as I discussed the example of trader versus distributor, uh, we need to understand the difference that a distributor would be doing much more work than trader. Trader is the buyer and seller. So this classification in many cases is there's a thin line of difference, and it was challenged to understand that is it a trader or a distributor or full-fledged distributor or limited risk distributor. So this has been the overall challenge. But the point I'm making here is that these are issues which can be addressed if we focus on the substance, if we focus on the overall objective of transfer pricing, and if we focus that the transfer pricing not just a subject of compliance, at the time of audit we need to show the substance, we need to show the documentation. So when we need to prepare documentation, it is very, very important to put ourselves in the shoes of tax authority, that what could happen, because the most of the transfer pricing litigation around the world happen in those cases where the documentation is well prepared, right? So the other side of transfer pricing, it is very, very important, which is so underrated, and we need to keep in mind when we look into the subject of transfer pricing. Now, I'm not going to too much of theory, but the point I'm making here is that whenever I do an analysis, I generally avoid using the term benchmarking analysis. A lot of places, specifically in this region, we use the term benchmarking analysis, that I want to get the benchmarking analysis done. But then if you really see, benchmarking is just one part of the overall analysis. The whole analysis is the arm's length analysis, which includes the functional analysis, which includes the commercial rationality analysis, which includes the selection of the method, and finally we do the benchmarking analysis. But the unfortunate part is that we replaced the entire arm's length principle by using the term benchmarking analysis. The moment we talk about benchmarking, it just represents that we are just comparing the data with the third party database, and we are just computing the arm's length price. We are not looking at the wider picture of the arm's length principle. And that's where this could create a lot of risk at the time of audit, because we need to see the various factors. Now, in this slide, if you can see, when we talk about the arm's length principle, the definitions start with the where conditions are made or imposed between associated enterprises. It talks about condition. It is not talking about price or comparability. So these conditions we understand only when we understand that the transfer pricing, we need to understand various factors. Now, which are those factors? These are factors are contractual terms. We discussed on the agreement. It can be, it is functional analysis. It is characteristics of the property and services. So I give you example. Let's say a company is into electronic distribution of electronic products, and I need to compute the arm's length price of that transactions where the company is purchasing and selling in the local market. Now, for that distribution of the electronic products, electronic products, mobiles and other related items, I need to select the right set of product. Now, I cannot select the electronic items which are used in the medical or hospital, right? Those are electronic items, but those are nowhere linked to the mobiles or tablets or other relevant items. So this is called characteristics of the property or services. Means what is the property of the product? Do I have the full understanding of the product before I deal with the arm's length analysis? If we do not have, our outcome will never be appropriate. Taking another example, a company which is into research and development activity in a pharma company, and that research and development, one company is providing R&D services to another company. Now that is R&D services where they are doing research on the drug discovery of the cancer. I've seen one cases that R&D is compared with the clinical trial services. Now R&D is different. Clinical trial services are different. Clinical trial happens when the R&D becomes successful. So the point I'm making here is that it is very, very important to look at all the conditions also when we do the benchmarking analysis, not just directly looking into the database and performing the overall analysis. So we have the contractual term, function analysis, characteristics of property and services. Then we have economic circumstances. Now, what could be the economic circumstances? We have seen the biggest the issues in the world. We have seen the COVID, and we are now seeing the geopolitical situations. Now, these are the economic circumstances. If we don't consider these, our outcome will never be appropriate. If any entity in the Middle East is affected due to this geopolitical situation, the arm's length outcome, we need to adjust those, right? We cannot compare with the other entities in the other region and say that okay, transaction is not arm's length or it is at arm's length. We need to consider those situations, because an entity could be losses because of, not because of the non-arm's length pricing, because of the economic circumstances. In case of when COVID happens, a lot of companies are into losses. So what we have done, we have taken the 4-year, 5-year data so that it brings the real life cycle. If we just see the 2-3 years years of data life cycle, it will never be give a real picture. So we have to be very pragmatic, and these things will be never documented or covered indirectly in the regulations. So if you see the real transfer pricing regulation of the UAE, it's just covering 3-4 articles. That's it. But if you see the TP guideline, it is covering more than 300 pages. Why? Because the OECD says that transfer pricing is both art and science. And there could be a lot of possibilities because every company is different. The circumstances are different. The value chain is different. So it is an art. It is a mix of art and science. We should be an artist as long as we are within the framework of the law. So this is very important that we take a pragmatic approach. And the last, the fifth circumstances, business strategies. So business strategies again are very important, because if any entity is doing marketing efforts, a lot of marketing expenses and losses are because of the marketing penetration strategies. So let's say a company which is doing a lot of marketing spend locally and it is into loss and it has related party transaction also, we need to document the business strategy clearly in the local file that losses are on account of business strategies and not because of the non-arm's length pricing of the transactions. So this is the whole point about looking into the various circumstances when we do the arm's length analysis, and not just looking at just only the benchmarking analysis. Commercial rationality. Now, this is again overall part of the arm's length principle, but generally we don't document it. But it is very important to evaluate while we do the entire analysis. So every problem in transfer pricing can be addressed with the one formula that in an independent situation, whether the independent party would be willing to pay for the similar service or similar royalty. If it is not, then it is not an arm's length price, right? So commercial rationality is basically looking the transaction from a commercial standpoint, that is it justified commercially to pay so much of salary, to pay so much of management fee. If we feel that if it is not commercially justified, whatever the level of benchmarking will do, it may not survive at the time of audit. As an independent consultant or as an independent tax professional working in the company or a consultant side, it is very, very important to evaluate that as an independent person. If I look at this transaction, is this transaction commercially make sense? If it doesn't make sense, whatever level of comparable data we choose or whatever, at the time of audit, it may not survive. So the point is that in an independent scenario, whether if we think that if this transaction would have been between the third party, would that transaction would be in a similar situation, similar price, then it is fine. So we talk about function analysis and conditions. There are certain risk steps. Now I'll not discuss because we had to cover various practical case studies, but when you get these slides, you will find this, that there are steps for functions. We already discussed that there are functions, there are conduct, there is a risk, contractual, everything we need to evaluate, and then basically we need to include on the arm's length pricing. Now transfer pricing is beyond year-end compliance. Like it is not. So one thing is very important to understand, that in order to avoid the transfer pricing risk, we need to consider transfer pricing from the day one when the decision is taken for entering into that transaction by the company, and not at the year, not at the time when the tax return is filed. because I've seen number of cases where TP is started at the year end, and suddenly the company identify that okay, there's a significant adjustment is coming. Then auditor also creating a lot of issues because of the non-arm's length situation, a lot of adjustments. So in order to avoid these all situations, not only from a compliance but also from an audit perspective, it is very important to look at the transfer pricing from the day one. And when we look at the transfer pricing from day one, at the time of entering into the transaction, we have a full visibility. We can maintain every month, quarterly, that there's no adjustment. Even if there's adjustment, the company has a full visibility, and that's where it will do the ease of compliance at the year end. And not only ease of the compliance, it will gives more visibility to the company for overall improving the overall financial health. It will reduce the transfer pricing risk of the audit as well. So this slide is very important to understand that TP is not just an year-end compliance. Uh, what exactly the TP policy? Now, a lot of time we hear about transfer pricing policy. In a number of cases, the TP policy does not exist. Now, TP policy is not mandatory. There's no mandatory requirement, and a lot of smaller companies even does not. They do not maintain TP policy as such. But TP policy, there's no formal documentation or a format specified anywhere. The point of TP policy is that if you have multiple entities, it is very, very important to prepare a one transfer pricing policy uh, at the time of entering into transactions. Now that policy is not that local file or master file. That policy prepared from the day, the first day when the transaction is entered, to to understand that what is the transactions, what are the function assets and risk, and this TP policy will be shared with various stakeholders of the company, the finance head, the operations head, because then everything is streamlined. So a lot of big groups, you will see that there is a global transfer pricing policy, because without TP policy, it is very difficult to maintain the consistency between the entities for the related party transactions. Now, in number of cases, even when they're in the UAE, I have practically seen that the number of entities are more than 3, 4, even 10, 20 entities, and then there is no transfer pricing policy of the group. While it is not mandatory, as I said, but the world is become more disruptive. The managing data has become more challenging. It is very, very important to have one transfer pricing policy which talks about not only the arm's length pricing of the transactions, but also how the cost is identified, how markup is applied internally. So if there's a transaction of management fee, as a consultant, I'll do the benchmarking and recommend the markup. But internally, if the company maintains the TP policy, the company will document the benchmarking analysis, the overall function analysis, not only benchmarking functional, how the cost is captured from the ERP, who is responsible for the approval, how the markup is charged, what would be the components of the cost. A lot of places where the cost is captured and including the extraordinary or non-operating expenses in the company. And that creates a lot of issues at the year end, because the ERP takes this as an overall cost, and at the year end we need to do the overall adjustments. So it is very, very important to maintain a TP policy as per the arm's length principle at the beginning of the year or during the year, but not at the end of the year, because end of the year we need local file or TP documentation. So it is the TP documentation is the extension of the TP policy, but TP policy includes same what is there in the local file plus the governance framework also, that how the cost is identified, how different department uses that TP policy. So in number of cases in the last 1 year life cycle of the TP compliance, we have seen that the transfer pricing policy is missing, even when the number of entities in the group are more than 3 or 4 or even 10 entities. I have seen that there's no transfer pricing policy, and that creates a lot of risk at the time of audit, because when there is no consistency between the entities, there's no one document. Even when there's local file is prepared, local file does not guarantee, because local file is prepared for each entity separately. It does not guarantee the consistency. TP policy, global TP policy, guarantees the consistency of the TP policy across the group. Now, this is very important slide, that when we deal with the transfer pricing, we need to not only look into the regulation. So a lot of places we just look at the regulation. Okay, what is the threshold? What are the methods? Let's do the benchmarking. That's it. Okay. But then we need to look at the tax authorities approach. What is happening globally from on these transactions? what the tax authorities is doing in terms of outstanding receivables. So there have been number of ruling across the world on outstanding receivable. In the UAE now, audit has not yet started significantly, so we don't have any precedent. But we can look at what the tax authorities have been doing globally on the outstanding receivable. So when we do the compliance, we need to have this level of mindset where tax authority, where this level of mindset where we look into the every transaction not just from a benchmarking and completion perspective, but also from a perspective that what is going on in the globally in the world. I take an example of outstanding receivable. There are number of rulings on guarantees, that guarantee is not charged appropriately. There are number of rulings on court rulings on loans. There are number of rulings on royalty. So it is very, very important to keep in mind, because when the FTA will start the audit, they will definitely also look into the what is the global precedent, right? So it is very, very important to have that mindset, that putting ourselves in the shoes of tax authority before we before we finally take any position, rather than focusing on the just comparability analysis. Now I take a couple of case studies in terms of that what we have seen. uh, as we discussed, we already discussed the royalty part. Royalty, I've seen that number of cases the benchmarking is done, but then there's no benefit test demonstrated in the local file or in the documentation. It is very, very important to have that benefit documented in the documentation. If we don't, it can be any payment. It can be royalty. It can be management fee. It can be services. Benefit, documenting the benefit is very, very important, because at the time of audit, the first thing the tax authority asks, what benefit you are getting by getting the management fee. A lot of cases I've seen where services are being rendered, and those services are basically very admin in nature, and the terminology used in the financial is management fees. Now, this is very significant. The moment it is management fees and underlying conduct is just an admin services, it can create a lot of issues, tax authority, because admin services may warrant 5% markup, but the management fee may go up to 15%, right? So we need to understand the characterization of the services and then take a decision. Uh, Another example, so considering the case, this is a case of the licensed manufacturer, the entrepreneur. Now the case is like this, that the manufacturer is paying the royalty, and after making payment of the royalty, the entity is into losses. Now one thing I would like to discuss here is the important part is that just because any entity is into loss, it does not mean that the entity has done the transaction on a non-arm's length basis. A lot of time it is assumed, and a lot of cases in the discussion happened, that entity is into loss, so something wrong with the transfer pricing. No, it is not always the case. If I am an entrepreneur in the market, I may be paying royalty, that's fine. But I'm really doing marketing expense for the future. I have a good projections for the future. I'm really doing a market penetration strategies. Losses can be commercially possible, right? So the point I'm making here is that just because the losses, one should not conclude that transaction in non-arm's length basis. Transaction can still be an arm's length. We'll discuss the approach that in case of losses, how to address the transfer pricing. But the point is that losses does not only conclude that the transaction is a non-arm's length. We can still justify it based on the demonstrating the benefit documentation, demonstrating the entity is a risk-taking entity. Any risk-taking entity will be responsible for risk and reward for the losses and profit. We can do the DEMPE validation, which is the development, enhancement, maintenance, production, exploitation of intangibles, to show that every intangibles is placed here, and when intangible is placed here, the entity is entitled for the maximum benefit and maximum losses. So defending is easy, if even if when there's a losses, provided there's a strong documentation. Now one more example is the limited distributor versus full-fledged distributor. Now this is very, very important, that if we don't understand this difference, limited distributor versus full-fledged distributor, this can result into year-end adjustment. A lot of cases where company relied upon the contract. In the contract, it says that entity is just buying and selling, and it is entitled to earn just 2% margin. and it is paying less tax because the margin is just 2%. But when we really look into the characterization of the entity, we found that no, entity is not a limited risk. It is doing much more functions. It is developing the market strategy. There are marketing people sitting, and those are not something which is not even documented in the agreement. So we have seen those cases where there's a vendor negotiation happening. There are people, qualified people, skilled, highly skilled people sitting in the locally, and then it is not appropriate to say that entity is a low risk distributor. So in those situations, the margin should not be the 3%. So normally in this example, there's a 3% margin. The target margin should be 5%.
5%.
Right, right. So it should
So
be
it should
5%.
be.
There's some echo which is coming up. Just
Yeah, Ajit, now some mic got on, so it will not come now. Please go ahead.
okay.
Thank you. Thank you.
So the point I'm making here is that it should be 5%, not 3%. So the moment it is 5%, and we get to know at the year end, there would be year-end adjustments happening. Now, what is meaning of year-end adjustment? Means if the books are open, the entity needs to do a true-up adjustment, either by adjusting the purchase price of the goods or direct compensation. Now, year-end adjustment comes with a lot of other issues. It will comes with the VAT issues because there will be VAT impact. If there's a direct payment, there could be withholding tax impact. Withholding tax is not here in the UAE, but there could be other side impact, withholding tax impact. There could be custom issues because the price of the importing goods will change. So a lot of issues, cash flow issues. So it is very important to understand the characterization, not based on the agreement, but based on the overall characterization of the entity, that is it a full-fledged distributor or limited risk distributor. So this is the whole example. Another area which I would like to speak on is the intergroup services. So this has been a significant area in the UAE transfer pricing because a lot of services are being rendered between the group entities. It can be management fee, it can be accounting services, it can be IT services, or any other low value adding services. The point, so when we talk about this intergroup services, there are two type of services. One is, so let's say there is a group where one entity is directly providing services to another company directly. Let's say IT services. Company A is providing services to company B. So then it is a direct charge. So indirect charge, we know what is the cost. We know based on the markup, how much markup is to charge, which is very straightforward. The problem happens in case of the indirect charge. Indirect charge means, so let's say there's a real estate group in the UAE, and that real estate group has a internal IT department, and that has a massive services. It has a IT, cyber security, servers, various other costs. Now the model is that group is basically appointing one entity where all the third party cost is pooled in the one entity, and that is to be allocated to all entity based on some ratio. So practically I have seen in one of the biggest group in the UAE real estate, where the entity is one entity was responsible for the pooling all the cost, for all third party cost, and all costs are allocated to all other entity equally. Now this is such an important issue from a transfer pricing perspective, and that's create a lot of risk. Why? Because if we are allocating the cost equally, it means it is thus all the services are benefiting equally to each entity, but it is not the case. If there is a laptop services being rendered by one entity to another entity and all costs are pooled in one entity, but one entity has 1,000 employees, another entity has only 50 employees, how can the cost can be allocated equally? So this is a very significant issue. So the point I'm making here is that whenever there is an indirect charge of services where the cost is pooled in one entity, it is very important to allocate based on some rational allocation key. It can be based on number of users, it can be based on number of servers, or it can be based on number of tickets or number of servers. Or if we don't find any of these, sometimes we take sales ratio as well. So the point is, it is very important that we look into the overall, understand the nature of the services or third party cost, and on that basis, on the third party cost, we need to understand that how it should be allocated based on some logical allocation key. So for example, if there's a laptop repairing cost between the group, if I allocate the laptop repairing cost based on sales ratio, it will be not logical, it will be inappropriate. The repairing of the laptop has nothing to do remotely with the sales of the company. It's very, so the right approach is to number of tickets raised by the users or number of employee head count is the right mechanism. So we need to be very logical when we selection of the key. Another important point which we observed, that a lot of cases where the third party cost has been incurred, the third party cost, now that cost is basically allocated to all other entities with a markup. Now that is not appropriate. One thing which is very important in transfer pricing, the markup in any services would come only when there is a service element, internal service element. If company A is providing services to company B, then on that cost markup can be charged. But if company A is just pooling the cost, company A is not entitled to add markup on the third party cost. Company A can charge markup on certain people who are managing this pooling, but it is not appropriate to add a markup on the third party cost, the overall third party cost. So I've seen number of cases where markup is charged on the third party cost and then it is allocated. So which is not appropriate. Another area is low value adding services. So there's a concept in the UAE transfer pricing guide, and as well as it is coming from OECD. OECD has given us a safe harbor that if any services which is not related to the low value and not related to the core business of the activity, let's say laptop repairing or any admin services, then one can charge a markup of 5%. So this is in a number of cases this is very helpful, because then there's no need to do a database benchmarking. If any accounting, admin, HR services has nothing to do with the core business of the company, if the core business is real estate, then an admin and accounting is just low value adding services, one can directly charge 5% markup. But if there's a marketing services, then a proper detailed benchmarking arm's length analysis is required. So this is very, very important to understand based on function analysis. Is it a low value adding services or not? Another issue which we faced again is, I already discussed this, but I quickly mentioned that number of cases employees are working for one company and providing services to another. In that scenario also, it is not appropriate to add a markup on the cost of those employees. One can charge a markup only on the 2 or 3 people who are managing this payroll, but not on the all the cost of the employee. If there are 100 employees working on on the payroll of company A, but providing services to company B, then it is not appropriate to charge a markup on all the cost, 100 employees cost. The markup can be added on the people, let's say 3 people managing this entire payroll. On that cost, markup can be charged. Now, when the markup can be charged, when let's say there's a scenario where company A is not admin services, company A is seconding, making the employees available to another company, all the quality controls in the hands of the company A, it means the company A is actually providing services to company B, not just admin work. Then one can charge a markup on the services. So this is very, very important. I've seen number of cases where company A is just an admin payroll entity and markup is charged on the overall cost of the employee, which is very, very significant and which can be challenged by the tax authority from the from the entity which is a service availing entity, because that entity needs to pay a lot of money in terms of the markup. Another example is the shareholding activities. So a lot of cases where the entity is performing group level consolidation services, group level ESG monitoring, those are the shareholding services. It is very, very clear in the OECD guideline that shareholding services are not to be charged back. These are the group level services, not giving any benefit to any individual entity separately. They should not be charged they are not considered as intergroup services. So it can be board level governance related expenses, audit coordination, investor related expenses, or in number of cases I've seen that in the agreement itself, it is set to as a management fee, and all the expenses are covered as a consolidation related expenses, board related, and the markup is charged. In the first place, these services are not to be charged. It is very clear because these are in the nature of shareholding activity, and both OECD and the UAE guide also clearly mentioned that these are not to be charged. Coming to the important transactions of the loan, now there are significant, this is a significant transaction when it comes to the UAE. Significant loans are being given or taken between the entities because funding is very important. Now, as I already discussed, the one issue for the interest free loan where loan markup is required, in number of cases the tax return is filed based on the assumption that it is a market rate. I am providing market rate, but then that market rate is never analyzed, right? So if a company A is giving loan to the company B, and company B is a borrower, and the credit rating of the borrower is not good, like let's say B plus or maybe C or near to B, or credit rating is not good, then the interest rate should be high. But then that level of analysis is not performed in the documentation, and directly market rate is taken. When we take the market rate, that market rate is not evaluated from a credit rating perspective. So there are two important things when we talk about the loan. One is loan, there should be substance in the loan. A lot of cases the loan is just to take an advantage of the interest deduction, and there's no need for the loan amount. And tax authorities have been very aggressive in many countries on this. They may consider loan as an equity and disallow the entire interest. So this is very, very important that there should be a proper commercial substance behind the loan. It is not just doing the benchmarking. The second important point is that uh, credit rating of the borrower, which is very, very important. That we when we evaluate, we need to see that what rate we are selecting is the credit rating is similar to the comparable companies. One of the interesting case, we have actually conducted an arm's length analysis of the loan which is given, and in terms of the physical gold, and that has been one of the most interesting experience project I have worked on, where one company has given 200 kg of the physical gold as a loan to another entity. Now, this has been a very different kind of transaction, because when we talk about any purchase or sales, these are static value. But when it comes to the physical gold, the gold is a volatile. It keeps changing not only the principal but also the interest amount. So I'll not talk much detail about it, but how we have done that, there's no mechanism. We could have gone in the market and say that, okay, there's a gold loan interest is available, but then the circumstances are different. We need to see the circumstances, that is it a right circumstances for the comparability. If the comparability is the not right circumstances, then the comparable is not right. So we basically look at the IBOR, the central bank, the IBOR rate of the UAE. Then we make a lot of adjustments in terms of, we use the standard deviation to convert that IBOR to the rate of the gold to which the gold is fluctuating. And then there's a storage cost of the gold. We make further adjustments, and then whenever we go for the gold loan, we get the 80% of the amount only. So we then further adjustment to adjust to the 80%. So this has been very interesting. So the point I'm making here is that there's no formal process for all the transactions, one process. Every transaction can be different, and we need to take the decision based on the substance. The commercial rationality is very, very important. Everything in transfer pricing can be addressed, every challenges, with a one formula, that in independent scenario, whether I would be paying this same amount or not, that makes my transaction arm's length. Outstanding receivable, as we discussed, if this outstanding receivable for, let's say, there's no period specified, but then if the receivables are outstanding for, let's say, more than 6 months or more than a normal credit period, then interest can be maybe charged. So this is a significant issue in the region, and one need to ensure going forward in the second cycle, wherever we're working as a consultant or we are working in anyone working in the company, it is important to ensure that receivables are addressed or receivables are received within a credit period. Because if it is more than credit period, there will always be a challenge in terms of the arm's length pricing and in terms of the managing at the time of audit also. We can see in India in last 5 years there have been significant ruling on the outstanding receivables where there are different ruling favorable and unfavorable, where some courts have said that outstanding receivable in notional interest is required, and some courts mentioned that in outstanding receivables the interest is not required because the conditions of the working capital is different for the taxpayer. So it is case to case. But these things can be addressed when we work proactively. Uh, Another point which I want to discuss is the QFZP, and which is a very, very important issue in last 1 year I've seen. And we all know that transfer pricing is so important for the QFZP, because if we do not maintain transfer pricing requirement, the documentation and arm's length, one may lose the QFZP status. So this is very, very critical. Now, one of the issue, one of the debate which I've seen all across is that QFZP requires transfer pricing documentation, arm's length, and is one of the critical requirements. Now, there have been a lot of questions that what if the entity does not maintain arm's length throughout the year, but it maintains the arm's length just at the end of the year, either before closing of the books by doing some adjustment, or at the filing of tax return by making upward adjustment in the tax return. Will that create an issue from a QFZP perspective? Now, there have been a lot of debate and there are different views available. There are two views. The first view is that no, the arm's length principle should be followed throughout the year. It should not be at the year end, because that's the substance that is needed. That shows the intention of the entity, which is getting the 0%. But then the other view is that no, at the end of the day, if we read the tax computation guide, there's one place it is mentioned that the QFZP guide, the free zone guide, and in one place it is mentioned that the taxpayer should compute the arm's length price at the time of determination of the taxable income. And if we interpreted that line, it means that at the determination of the income we can manage that the transaction can be arm's length, even though throughout the year we have not managed. So there are two views possible, and I will not comment that the one first view is right or second view is right, because it is very important to wait for the FTA to give clarity on this point, because transfer pricing is one of the most critical requirements for the QFZP, and this is very, very important. And another point is that, see, QFZP, whether it is 0% entity, arm's length principle is applicable, whether QFZP is doing with other QFZP or it is mainland. Specifically, the mainland, because there's a de minimis requirement for the threshold for 5%, we need to ensure that the whatever transactions we are doing with the mainland entity, it must be at arm's length, and in no situation it should cross the threshold of de minimis, because there could be risk of losing the QFZP status. So these are very two important points when we talk about the QFZP, that TP should be taken care very seriously. Transfer pricing, obviously, any case should be taken seriously, but specifically in QFZP, there could be two different views. So whatever views is taken should be documented strongly in the local file. See, one of the things we have learned over the period of years is that in transfer pricing there can be different views, but then having different views is a no problem at all. Not documenting our view in the local file strongly is a problem. So if I go with the view second, and if I don't document that opinion, that view strongly in my file, that why we have taken this approach, then it may create an issue. So when I say documenting, it does not mean we should give extra or a lot of information to the tax authority. It means whatever is needed to ensure that why my transaction is arm's length, everything should be documented properly. So de minimis is one, and second is this TP requirement. There could be two views. So conservative view is that one should be arm's length from the day one, and it is the most pragmatic view, that why to wait at the year end? It should be from day one. Now come to the losses and transfer pricing. Now this is very, very important issue, that if there is a losses, how we can address the transfer pricing issue. So if any entity is into loss, there are various mechanisms to address the TP issues. Now the first mechanism is that in a lot of cases the the related party sales is just 10% of the overall sales. The related party sales is just 10% and third party is 90%, and overall entity is into loss. The first thing we should do is create a segment financial between the third party and related party. Now, this is very, very important, because if the entity is overall loss and my related party is just 10%, it is not appropriate to look at the entity level P&L. We need to compute the segment. Now, how we compute the segment? We will have the revenue for third party, we related party, a third party would be balancing figure. We can get to know that direct cost. We get to know that what is my purchase cost for related party. You will get for the third party as well actual cost, and then all other expenses to be allocated based on the sales ratio or any other ratio where we feel that we have a better ratio. The moment we do this, in this example, if you see, the related party is turning out into profit and third party into loss. So our problem is solved, that we do not need to focus the third party or overall entity. We just need to focus on the related party. Now, this formula does not work everywhere, because in other cases, there may be transaction on purchase side, sale side. There are multiple transactions. Then this segment, preparing segment, not possible. Then what is the alternative? Alternative is this: in case of losses, forget about the losses. Let's look at the transactional level analysis. Let's do the transfer pricing for each transaction separately. If there is a purchase transaction, sale transaction, let's do everything separately and do a separate analysis. That is another transaction, separate transaction by transaction analysis. If you can see on the screen that purchase, we have a separate results, management fee separate, royalty separate, everything separate, and everything is arm's length. So we have some, I've not discussed because of the short of time. We listed down some documentation checklist that in case of the losses, what should be the step. Now I come to this latest provision, the update regarding the director or officer, the latest update. I'll quickly discuss this. Now, so far what has happened is Article 36, we all know, talking about any payment made to a director, officer, owner, or related party of these people. There are two conditions for deductibility. The first is it should be at market value first, or and the condition is and. The second condition is it should be wholly and exclusively for the business purpose. Both the condition needs to be satisfied. Now, there was one ambiguity which on the meaning of the director and officer, and there were a lot of ambiguity whether general manager is an officer or not, whether an executive director is a director or not, whether director of operation is a director or director of finance is only director. Now, FTA has clarified that who is a director and who is an officer. Director is the person who is formally sitting on the board of director. So it means the FTA is now bringing the governance into the picture. When any payment made to director, we should not just see that it is a sales director or finance director. We need to see whether that person is on the board or not. He can be, first of all, he's on board. Then he can be executive director, temporary director, alternative director. It extends to board of trustees or any governance board as well. So the point we are making is now there is a clarity in the regulation with this notification. Whenever see any payment to director, if it is a financial sales director, they will not qualify for the director unless they are on the board, governance board. So this is very, very important to understand the overall governance. Are they on the board or not? Now, having on the board means they must be taking significant decisions. So substance also comes into the picture. So they must be on the board. They must be taking the decisions. Now, the sales director and finance director not on the board are out from the definition of the connected person, but they can still be the officer. Now, the FT has now clarified who can be the officer. Even a person, a finance director or sales director, not a connected person, but he can be an officer, and Article 36 applicable. Why? Because the article now with this clarification, officer can be a person who is responsible for planning, directing, and controlling the activity. So normally a finance director and sales director is planning, directing, and controlling the activity. It is basically taking strategic financial operational decisions, then it is an officer. It is binding the company in a contract. And then without ultimate decision making, they will not be an officer. So decision making and actual substance comes up with this definition. So we need to understand, one is the director with the governance, another is the officer where there should be a decision making in form of operations decision, financial, commercial, in terms of the planning, in terms of the controlling activity. A general manager can be an officer, or he may not be the officer. He just work on behalf of someone having no decision making authority. A vice president can be an officer if let's say vice president of marketing, because he's taking the marketing decisions, he's planning and directing and controlling, he's taking some decisions. So this is very very important from a transfer pricing perspective with this clarification. So with this clarification, whenever we document in our documentation, local file or documentation, it is very very important to document this governance framework, that why director is part of the governance, and if there's any other person, VP, general manager, or any other sales finance director, why they are officer, what decisions they are taking. So that matrix is important to document. So I just listed down that who is an officer, who is not. A divisional head or HR head, just routine providing routine function, is not an officer. A power of attorney holding, just doing admin function, is not an officer. An outsourcing manager, not an officer. A court appointed trustee just doing the monitoring is not an officer, right? So employee with just director title, not doing any significant activity, is not an officer. So this is very very important. Now we are short of the time. We have one more section to complete. If there is additional time, we can complete it. Otherwise we can take up the questions. I think we have covered. Sir,
Yeah.
if you are
Yeah,
fine, we can take up, or otherwise we can take up the questions.
yeah, Ajit, there may not be much questions today. If there are, we can extend it to for 25 minutes more. So you can take 10-15 minutes more to cover important topics, and then we can go ahead with the questions if it's fine, if you have time.
Okay, sure.
Yeah. Okay.
Yeah, that's fine. So I will.
Okay.
So this is an important section, comparability adjustment. I have spoken about this section, because this is so underrated in this region, and I think due importance is not given to this topic, the comparability adjustment. See, when we talk about transfer pricing, we talk about the benchmarking analysis. Performing adjustment is very very important, because the OECD clearly acknowledge that uh, we will never get the perfect comparable, and it keeps saying that. But still, when we look into the transfer pricing practically, we always after the perfect comparability. We never reach the perfect comparable, and OECD keeps saying that it is very very important to do the adjustment in the transfer pricing, uh, because if we don't do the adjustment, we will never reach at the perfect comparable. Now what are those adjustments? There can be many adjustments, but three important. One is the working capital adjustment. Now, working capital adjustment is so significant. Let's say one company is into distribution activity having significant receivable, and we are comparing with another entity which has no receivable. So this is a significant impact could be on the P&L for the company having no receivable. The margin would be different, because the opportunity would be different for the company having no receivable comparing to the entity with having the lot of receivables and payables. So the point I'm making here is that whenever we see the two performing the analysis between between the company and the other third party comparables, we also we should also perform working capital adjustment wherever possible. If we don't do that, then we have not basically reached at the conclusion, right, appropriate conclusion of the arm's length analysis, because then we are left with the comparability where the receivable, payable, inventories are completely different. And then we are saying that, okay, the benchmarking is appropriate. Now, this is not how it works. So we should perform the comparable working capital analysis. The how it works, that we have a tested party, our own, let's say, taxpayer or a company, where we have a trade receivable of 20%, we have an inventory of 15% on sales, we have a payables on sales, and overall we have working capital ratio of 27%. Uh, but if we see the comparable, the ratio is 16% only. The difference is 11%. Now, 11% is the difference in the working capital. That is significant. And that is basically is an opportunity loss for the company. The company would have used this working capital in earning the interest. So what I will do, I will apply the 5% interest, let's say some market rate, and this would be my overall impact on the profit and loss. So earlier my margin is 4%. Now the comparable company margin is 4%. Now I will increase the margin of 4.55%, 4.55. That will be the real adjusted margin to which I should compare with the tested party margin. So this is very, very important. So the important is not the calculation. The important to understand the concept that if there are differences between the working capital on account of debtors, inventory, payables, we need to look into both tested party and also the comparable, and based on the same we need to adjust based on the interest rate, the opportunity is foregone, and that would be the profit we should adjust and then do the comparability analysis. Another is the volume adjustment. So a lot of time we apply cup method, that okay, this is the transactions, I am selling to related party at 100, I am selling to third party at 120. But then we should also understand that the I am selling lower to related party because the volume is higher. If my volume is higher, if my volume is higher, obviously I'll give the discount. Just because I'm giving discount and charging lower price to the related party, it does not mean that my transactions is non-arm's length. So in this example, let's say company is basically selling at 100 USD 800, but actual price is 1000, and the overall volume is 1000 metric and here is 5000 metrics. So we need to make an adjustment here. So once we make an adjustment, we'll get some rate of adjustment based on third party data, that this would be the rate. And if we do the adjustment, let's say 14%, we get the real price and make the adjustment accordingly. So it was 800 earlier, we'll make an adjustment to make it 860 to ensure that both 1000 metrics and 5000 metrics are equal based on the discount, and we just need to make some adjustment, not the whole adjustment. So in the earlier one, if we just look at the 200 difference, we could have applied that 200 and multiply by 5000, 1 million of adjustment, but that is not appropriate. We need to see what is the adjustment based on the real discount and then apply accordingly. That is the volume adjustment. So putting adjustment is very, very important in transfer pricing. The moment we compute any transfer pricing benchmarking, the first thing we should look into that what kind of adjustment we should do here to make it a perfect comparable. Another type of is capacity utilization. So a lot of, let's say, manufacturing companies working on 190% capacity, but the comparables are working on 60% capacity. We get to know from somewhere that 60%. Then comparing the profitability is not right way, because the fixed cost would change because of the capacity utilization, right? So because of this change, we need to make an adjustment. That adjustment is based on the capacity utilization based on the ratio. If my ratio is comparable company 60, if 90, we need to make an adjustment on the profit, on the cost, and make the cost on the par based on the ratio of the analysis. So these are the three basically: volume adjustment, capacity adjustment, and the working capital adjustment. These are very, very important. Now I'll discuss the last slide, which is very, very important and interesting slide. I basically use this almost in all presentation, that this TP data management architecture I have created. So what happens is, over a period of years, when we talk about the TP documentation, in our mind, we just think about local file, master file, CBCR, and additionally the agreement. But then the TP documentation is so wide, based on my experience representing with the tax authorities, that it is not just the local file, master file. Tax authority I've seen have asked the board minutes. Tax authority have asked to look at the website. In few cases, tax authority have asked me to, come up with the actual product of the company. We have shown the actual product of the company to the transfer pricing officer. In some cases, they ask valuation report. In some cases, they ask for the ledgers, the budgeting, the approvals, lot of things. So this is the architecture. We start with the foundation. It can be TP policy, agreement, and entity structure, financial data, which includes audited financials, related party disclosures, invoices, and all those are not required in the local file master file. And then the third is cost allocation. Again, allocation is not even required to given in at the time of local file. Then we have the market data, CUP data, industry reports. In a lot of cases, we have submitted with the tax authority various industry reports, which are even not even needed for the local file. In some cases, we have submitted the quotation as well. Then the compliance, it includes the CVCR, local file, master file, benefit test documentation, justification of loss. This is very important. That a lot of cases the entity is into loss, but we don't even justify in the TP documentation. Email correspondence is very, very also important document. A lot of cases we have submitted email correspondence to the tax authority. Past audit records, advanced pricing agreement, MAP proceedings. So this is the architecture, and this can be very useful not only from a compliance but audit perspective. Now with this slide, I think we have covered the entire session, and now we can take up the questions. Over to you, sir.
Thank you. Thank you so much, Ajit, and deep gratitude for your session. Maybe you can remove the screen.
Sure.
And I now invite everyone to come up with the questions you may have. You can raise your hand and I will ask you to unmute. And we can spend 10 minutes time to take the questions. So look forward to some interesting questions. So request anyone who would like to take this opportunity to please raise your hand. Yeah, so we have one hand raised. Adarsh, can you please unmute and uh, yes,
Yes,
please
yes,
go
sir.
ahead, Adarsh.
Yeah, thank you so much for the session. Thank you, Prabhdeep sir.
Yeah.
So I have a quick question. So in case of receivables, basically, whenever there is a money which is lent by the shareholder to the company, right?
Correct.
So now a lot of times what happens is that is lent without any credit terms or without any period or anything like that. Just lent it, and the company would charge interest, right? Based on the okay,
Correct.
they'll do the benchmarking and they'll say okay, it is 5 or 7% or whatever. Now my question is whether authorities may would they treat this as equity, although because see now there is no clear repayment terms and there's no clear loan arrangement as such if you look at it. So is there a risk where that the authorities may treat it as a equity and they may challenge the interest expenditure? So what is the your take on this and how do we
Sure.
treat it?
So
Yeah,
this is a very important point, equity versus debt. See, a
correct.
shareholder is giving loan to a company, quite possible, and equity can be considered in a scenario where the tax authority might come up and say that uh, why do you need this loan from your own owner, and you have a easy access availability in the market at a lower rate, right? So the moment there is a interest charge, there is a possibility they can challenge this, because what happened is it is not a loan between two companies, it is between individual and the company. And individual and the company, there is a kind of circular referencing, because individual is impacted if the company goes into loss, or if the individual gives loan to the company, then there's a both side impact. So there's a possibility that tax authority would come and say that yes, this is not something where you should be taking loan, this should be considered as an equity investment. Now, how to avoid address this situation? To address this situation is important to document the rationale of the loan, the time which is required to get the loan in the external market. A lot of other things can be substantiated in the local file, that why it is so feasible to take a loan from the shareholder rather than going in the market. And that way, there is a concept in the OECD. Okay, so the concept is called option realistically available, and this is most underrated concept in the transfer pricing globally, which says that the what options company had uh, if the companies goes in the third party market, options realistically available. And I've practically applied this concept in the local market in number of clients, and it's so underrated concept. And surprisingly, none of the TP regulations in the world talking about or covering this. Now this concept says that option realistically available. So what I will do, I will document it by saying that, okay, if I go in the market, I had no better options available to take this loan. The best realistic option available for the company is to take the loan from the shareholder only, because it is immediate, because there are no such compliances, and because it should be taken as a loan only, because I need to return, and that loan is on account of the personal funds of the shareholder rather than a company fund. So see, we need to document accordingly, and then it can be challenged. As far as interest is concerned, see, if it is 0%, then chances or audit becomes less, because it's a 0% interest, right? So authority would not challenge it. Authority, whether you consider equity or loan. But the moment there is an interest rate added to it, it is important to ensure that the interest should not be more than IBOR, right? Maybe should not be 5%. In some cases, I've seen the shareholder are charging 10% interest on the loan given, which is so significant, right? So the point is that 0% loan for a company, borrowing company, is always an arm's length. 0% interest for a borrowing company, always an arm's length. And specifically for the individual side, where there is no tax in the hands of individual, there is no case of double non-taxation. So it is at arm's length. So with this all documentation, one can address the situation.
Thank you. That was really helpful.
Thank you, Adarsh. I see that many of you have weekend commitments and you have to go today due to a clash with ICA Dubai chapter session. We had to move it to the afternoon time. If anyone has any questions, we still have 5 minutes. We can take that up. And thanks to Ajit and all of you who have overstayed. Anyone, any questions? No, I think. So, yeah, Adarsh, you have.
Sorry, if I may take one more
Yeah, please.
question.
Yeah, please, please.
So,
Okay.
for the local file, so basically we have a condition, we have a criteria where, uh, if the transaction is between the related parties and who are in the same tax rate, that is, for example, 9%, and they are not part of the M&E group. So there is a ministerial decision which says that we don't have to document or report those transactions in the local file. So now, suppose if that company does not have any transaction outside the other group, like basically they have the companies within the MN, within UAE only, they are not part of the M&E group. However, their turnover is more than 200 million in AED. So technically, they are supposed to maintain local file. But if you look at the ministerial decision, it says, the transaction between 9% entities need not be reported. So should we prepare a local file and document saying that, okay, based on the ministerial decision, we are not reporting this transaction? Should we prepare a mini local file kind of thing, or should we not prepare a local file in such case?
So this is a very interesting and important point which has been debated across various forums.
Yes.
So the point is, I understand the ministerial decisions clearly saying that if the tax rate is same, no need to no need to prepare, no need to report in the local file. Now I come to the point in terms of how to address this point, right? See, there are two things. One is reporting in the local file, okay, and determining the arm's length price. So the ministerial decision nowhere says that you should not compute the arm's length price, correct? So first of all, the arm's length principle is still applicable even if the tax rate is same. Now coming to reporting of the in the local file. Now I understand you have only those local transaction only, no other transaction, correct?
That's right.
That's right. Now see what happens is, if there are only those local transaction only, there are no other transactions, then one can take a position not to basically report their transactions in form of in that local file. But the problem happens that the moment you crosses the 200 million threshold, there is a requirement to prepare local file. Correct? Now, there's an ambiguity that non-reporting of the local transaction, does it mean the exemption from the entire local file? Which I have a doubt. There's the ambiguity here. What as an independent consultant, what pragmatic approach I would take? I would, I would, I would not consider this ministerial decision. I would consider this ministerial decision only in a cases where the transactions are insignificant, like not material. I tell you the reason for this. Why this can be more pragmatic approach. If the transactions is immaterial, then one can take this approach of not considering the ministerial decision. But if the transactions are significant, then one should not take the chance and to take a pragmatic approach to prepare the detailed local file, because uh, you know the regulation is not very clear about the local file. It is clear about non-reporting of the transaction, but about the preparing of the local file, it is not clear. So at this point of time, I will take the pragmatic approach and prepare the entire local file based on those transactions. Now, there could be one complex situation, I tell you. In your case, you have mentioned there are only local transactions. Now there can be a situation, and which is actually addressing this issue to some extent. There could be a situation where there are local transaction and there is a cross-border transaction also. Now what happens is, a lot of cases, your value chain of the local transaction is also connected to your cross-border transaction, right? In number of cases.
Yes.
If you don't report that transaction by following the local ministerial decision, then what will happen issue that we will not disclose the entire end-to-end value chain in the local file, right? We will say that, okay, while there are cross-border transactions, we'll report only cross-border. But if you are a distributor, your value chain will complete only when you show the entire end-to-end value chain. When you show the value chain of a cross-border connecting with the local transaction, then you will finish your entire transaction, right? So in the second scenario, it makes very complex and one cannot skip because of the ministerial decision. Ministerial decision may be for some administrative perspective, maybe for some regions where transactions are straightforward. There are only domestic transactions. But where there are transactions are complex, connected to the cross-border, it is not recommended to skip and just report the cross-border transaction.
Yes. Thank you. Thank you so much for the detailed
Thank you.
explanation.
Thank you. I think we have two more questions, Sonal and Ramachandra. Maybe Ramachandra ji, your mic is on. If you would like to ask your question, you can ask. Then I'll go to Sonal. Yes.
Good evening. I just have a question on payments to directors.
Correct.
Sorry, directors and shareholders. One of the shareholder is a CEO of a company, and he holds around 30% shareholding, and he gets a salary of total overhead cost is more than, I mean, it constitutes more than 50% of the total overhead cost. And the company has been making consistent losses for the last 10 years. Now, for TP purposes, and the benchmarking, how will we go about it, and how will we go about this?
Now, this is a very, I would say, significant issue, and company has been incurring losses for last 10 years, and at the same time paying significant salary to the CEO or owner. See, 10 years is a very significant time. Now, I'm not saying that the salary is non-arm's length on the face of the facts. What I will do, I will integrate further and ask about the overall plan. See, I'll not go back. See, transfer pricing is not a retrospective. Okay. So tax authority in the UAE, when they do the audit, they will not go retrospectively. They will not see that what has happened in last 8 years or 6 years, right? So it is a prospective regulations. So what I will do in the year under consideration, let's say 2025 or 26, if the CEO has taken significant salary and company is into loss, the first thing I would ask the company is that when they will be in the profit, do the company have any projections? profitability projections. The company say, yes, we will be in the profitable in next 2 years or 3 years, and we can give you the uh, calculated profitability projections with the appropriate factors, with the evidences. Then I can consider this case for that particular year, that okay, the company believes that it is the company would be profitable, and just because the companies incur losses doesn't mean that the CEO is not entitled to that salary, because the CEO might be doing a lot of effort. So first thing, I'll do the projections. The second thing, I do the document all the functions and decisions of the CEO, what contribution he has been doing in last 1 year. That is very, very important. And by looking into the entire thing, and also I'll do one thing, that what is the reasons for the losses. So if I remove the CEO salary, would that convert into profit? That's first thing. Even if it convert into profit, for what is the role of the CEO, like what decision critically it is being taken, that is very important. And if after removing the CEO salary, even if that the company is into loss, then the reason for loss is something else, not only the CEO. So I will document that also, you know. So see, this is not a very scientific exercise, because the provision is like that I don't expect FTA to come back and issue a guideline that you should compute salary in this way, because the world is so different, every company is so different. A CEO of one company can have a 25,000 salary, a CEO of one company can have 1 million salary, right? So the world is so different. So it is, I would not see any time in the future where FTA would come up with some guideline of how to compute salary. It's our own mechanism, our own approach, that how confident we are in the building of the case by documenting the profitability projection, losses, why the company is into losses, what decisions CEO has taken, and overall analysis of the losses of the industry. Then we can build up the case. So this is a more of a narrative building exercise in the documentation. If we are able to build that narrative with the, so when I say narrative building, it's just not documenting the in the just in form of para. We need to have a backup documentation, evidences. It can be reports, it can be board minutes, it can be any other reports, it can be some industry reports, anything. So if this is built, then this case can be addressed. But if there are no such issues, no such evidences, then it is a challenging case to defend before the tax authority.
Okay, so thank you so much.
Thank you. Sonal, can you please unmute yourself and ask your question?
Hello, sir. Good evening.
Yeah.
So, in the public clarification, it's given that if a person is connected person and related party, we'll consider it as related party. So, my
Correct.
question is with respect to corporate tax disclosure. So now in the return, if we are paying salary to a connected person, but he's a related party also, so we will disclose that in the related party schedule. So the threshold will change from 500 thousand to 40 million and 4 million. Like this is not what is given, but this can be interpreted like that, no? So
No, I mean, we should see the substance of the provision. So substance, what says, so sometimes what happens is that individual is a connected person based on the
yeah,
provision. And at the
yeah,
same time, it also fits into the control definition, right? So
yeah,
there is a provision of control in Article 35, right? So control.
yeah,
So the point is that if it is considered as, so I know there's some bit of ambiguity that the law says it should be a related party.
yeah,
It is the law is saying in the sense of when there are basically two corporate entities, not in the sense of when there's a payment made to an individual. So here my
okay,
interpretation would be that if any payment made to the individual, any connected person, and to whatever extent it is a related party, let's say, for control. But
yeah,
I would still consider this as a connected person, because what will happen is, if you disclose the salary in the related party disclosure, there is no appropriate columns only in the related party disclosure, right?
yeah,
How will you
exactly.
report the salary? The real format is in the connected person schedule. So you
Yes,
will not change the format. Your connected person would be in connected person only. your related party would be in related party, right? So
Yes.
there can be some exceptional circumstances where company can be a connected person. Okay, so
Yes.
in that situation, it should be related party and should be reported in the related party section. But the individual for which the payment of salary is given,
Hmm.
it is very clear it is to be connected person, because in the
Okay.
related party schedule there is no such format to disclose
Yes.
it.
Okay, sir. Yeah, got it. Thank you.
Thank you, thank you. So thank you everyone. Thank you Ajit for your very inspiring and very insightful session. What would your last words will
So
be before we
I
close?
would like to say, sir, thank you very much for this opportunity. It has been indeed a great opportunity to present. While I present at the other forums, but
Yeah.
the way we connected, we started, I rarely see this kind of introductions, this kind of connecting with the people, and that's made a real difference when we take any session. So I think it's had been a very great experience for me as an individual, and I would like to, have more opportunities to present with you in the future on different topics. But yeah, I mean, I would like to thank you for your journey, what you have built so far, and it has been really inspiring for the other professionals and other CAs as well.
Thank you so much. Thank you everyone for joining and sparing your more than 1 hour 45 minutes for this session. Thank you Ajit for your encouraging words. We look forward to host you again very soon. And with Saturday evening waiting for us, my last word is that next week at 11 a.m. UAE time, we will be here for AI session and AI, where we will practically talk about the tools which can make a significant difference to your productivity. So, with this, thank you to Ajit once again. Thank you to you
Thank you,
all.
sir. Thank
Have
you
a
very much.
safe, have a safe uh, time. Have a safe celebrations or safe commuting. Take good care of yourself. See you soon
Thank you very
again
much.
next Saturday. Bye bye. Thank you.
Thank you. Bye. Bye.